wonderful traders, and welcome to lesson 3 of this online forex course. My name is Emeka from ImoFX, and while watching this video, if you find anything confusing, kindly drop it down in the comment section and I'll be glad to clarify on your questions. So let's dive into it. So welcome to lesson 3. This is the secret to achieving a consistent trading forex profit. And if you observe, I use the word consistent and not a large trading forex profit. You know, would you rather achieve a consistent profit month after month, year after year, or just a one-time big profit and just only to lose it the next day or the next month? So why I say this is, in trading or in forex in general, you hear about people who make like 2000% in a month, 100% in a month. That's quite a big amount of return in forex trading. So, but what they don't tell you is that they lose the money the next day, because you only hear about the positive return. No one talks about the negative return. So what I'm about to teach you now is the secret for you to be consistent in forex market. It doesn't have to be a large profit, but it has to be something that will keep you consistent in the market month after month and year after year. So almost everyone in the forex market can make money in this forex market. Almost everyone can make money, but not everyone can make money consistently. Because when you think about it, the market goes in two directions. It either goes up or it goes down. You don't need to be a rocket science to know that. So as simple as placing a bet whether the market will go up or go down, and it's just a 50-50 chance. If you get lucky, it goes your way and you make money. So it's that simple. You don't need any technical analysis or fundamental analysis to get that right. So you just become right 50% of the time. So what is the secret to achieving a consistent trading profit? So I'm telling you that only just few percent of people who trade forex make money consistently. So how do they do that? Do winning traders have the ability to predict the market or the future more accurately? I know a lot of people might think yes, but the answer is no. So the secret of winning traders is the ability to think statistically and exploit the statistical edge. Now I know this might sound a little bit complicated, but let me just explain what I mean. So what you have to understand about forex prices, stock prices, or any other prices in the market, it moves randomly in a very short term. So in a short run, it moves randomly. Like price either goes up or goes down, it's 50-50. It's a random outcome. So to get a winning trade in a short run, it really depends on a random outcome, and it's a luck. So to win consistently, we cannot depend on luck. So how do we assure a consistent profit from a random outcome? Now to explain this, let me use a metaphor. Let's imagine I have a game I want to play with you, and the game is like tossing a coin. So what happens is that while we are playing the game, you have to bet $1, and I will toss a coin. If it comes out like heads, you will win the $1.50. If it comes out of tail, you will lose your $1. So let me ask you this question: is this a risky game? Well, it depends, right? So if $1 is all you have in your life, you should not play this game, right? So there's 50% of chance that you're gonna lose everything you have. So it's too risky. Okay, now what if you have $100? If you had $100 and each time you bet $1, how many times will you bet? Well, you can bet 100 times, right? So let me ask you a question. If you play one game, the chance of winning the game is 50-50. But if you play 100 games, what is your chance of making money at the end of the $100, at the end of the 100 games? Now think of this question and kind of guess the answer. Now, is it 50-50? Is it less than 50-50? Or is it more than 50-50? Oftentimes, if you ask people this question, most people will reply and say that it's 50-50. That if you play a game 100 times, the chance of making money in a long run is a 50-50. Or some people might even think that it's less than 50-50. Now, if you play this game 100 times with $1, the chance of making money is almost 100%. It's 99.99%. Now, how is this so? Now, it's based on mathematics or probability. Now, if you ever studied probability or statistics in school, you know that whenever you play a game of chance, you can calculate the expected profit per game. And the formula goes this way on my screen. It goes percentage win times average win minus percentage lost times the average loss. That's the formula, and that tells you if your expected profit is positive or negative. So let's use this formula now. What is your chance of being right or winning? 50%, because it's either a head or a tail. So percentage win, 50%. Percentage lost, 50%. Now, what's your average win? In this game, your average win is $1.50 and your average loss is $1. So if you put that in this formula, you get 50% multiplied by 150 minus 50% multiplied by $1. Do the math, you get 25 cents. So what does that mean? It means on average, anytime you make a toss, you're gonna be making 25 cents, right? So what does that mean? That means that over many random tosses, on average, anytime you make a toss or you play a game, you're gonna be making 25 cents. So is this a positive return? And the answer is yes. So this tells you that this game has a positive expectancy. So what this means, if you play this game 100 times, that is 100 tosses, you will get an average of $25 in total profit. So let me just draw this up for you so you can understand. So your expected profit per toss or per game is 25 cents. And this is per game. So if you play 100 games, this means that statistically, you made $25 in profit. Now, what are you going to do with this? And I'm serious about this. I would like to grab a coin, and when you are free in your free time, please do it. Grab a coin and toss it 100 times. Each time you get a head, write down plus 1.5. If you get a tail, write down minus 1. And after 100 toss, get the entire result, write it out. You can see what you get at the end of the toss. 100 toss is going to be positive. So now, how is this possible? When you try this, you'll be asking yourself, how is this possible? I mean, each game, each toss has a 50-50 chance of occurring. But why is it that over 100 games, you ended up making money? Because the secret lies in the fact that the average win is greater than the average loss. So it's a secret of achieving a consistent return from a game of random outcome. Now, here is another way of looking at it. If you play 100 games, it means that you get an average of 50 hits, or 50 wins and 50 lose, right? 50 wins and 50 losses. And each time you lose $1. So you expect to lose $50 from the losing side. And you expect to make $1.50 for the 50 wins. So 50 times 1.5 is $75. So 75 minus 50, you get $25. So that's another way of looking at it. Now, let me ask you a question. If you toss a coin 10 times, will you definitely get 5 hits and 5 tails? The answer is no, of course. Could you get 7 heads and 3 tails? You could get 9 heads and 1 tail. You could get 5 heads and 5 tails. It's just a random outcome. So in a small number of tosses, the outcome is random. It's based on luck. So, but if you toss it 100 times, 200 times, 300 times, with that number of large sample size, the event will come out to be 50-50, because that is the statistical probability of the outcome. So the same thing is applied in trading. Whenever you place a 5 trade or 6 trades, the outcomes are pretty random. It's possible to even get up to 6 winning in a row and 6 losses in a row. So in a short term, it is luck that is playing out. But if you trade up to 20 times, 50 times, and 100 times, it's no longer luck, it's statistics playing out. Because at the end of the day, you're gonna end up making money if your average win is greater than your average loss. So all you need is just to be right half of the time. Now, what if you are right less than 50%? Let's imagine that you toss 100 times and you get say 60 tails and 40 heads. What happens? So let's do the maths. Let's you get 40 wins and you get 60 losses. So each time you lose $1. So that's minus $60. And each time you win, you make $1.50. So 40 times 1.5 is $60. So 60 minus 60 is break even. So this means that even on an event where you toss 100 times and you get 60 losses and just 40 wins, you will come out as a break even. So you still end up not losing, you still end up not winning, not losing, you end up at break even. So as long as you can be right just half of the time, or just slightly half of the time, you end up making money at the end of the game. So how do you apply this in trading? So in this game, when we lose, we only lose $1, right? But in trading, can we predetermine how much we're gonna lose in a trade? And the answer is yes, we can. And we do that by placing a stop loss order the very moment we enter a trade. So by placing a stop loss, we predetermine how much we're gonna lose in a game or in a trade. So we have to pre-calculate the size of our position so that when we lose the amount that we stipulated to lose. So while losing, we make sure that we lose a small amount of our capital. And in my suggestion, I'll recommend that you trade with less than or up to 1% of your total capital. And when you get a winning trade, you must win more than the risk amount, which is the 1% you risk for the trade. So if you lose 1% in a trade when you lose, and when you win 1.5% of your capital, which is like 1.5 times your risk. Now, if you risk, say 3% in a trade, which is the maximum I recommend you should risk, and when you write, you make 3 times 1.5, and 3 times 1.5 is 4.5%. So if you are trading stocks or you are trading cryptocurrency, it's not the same with Forex. So in Forex, I don't risk more than 1%, and while trading Forex, I don't go for risk reward more than 1:1.5. So I risk 1 to gain 1.5 in Forex. So if you manage to make $25 on a $100 capital, that is 25% return per month. Now the good thing about Forex is that it's a 24 hours market, so you can trade anytime, any day, except the weekend. So the next one is, how do we apply these principles of consistent profit in trading? So now in trading, remember, if you enter the market on a given day and you buy the market randomly, and for instance, you take a coin and you toss it and you buy based on what the coin says, the chance of you being wrong or right is still 50%. And that's not what we want. We want a better than 50-50 chances. So we want to get an edge over a random occurrence in the market. So how do we get this edge over the market? We get this edge by the use of technical analysis. So that's what I'm going to teach you in the next few lessons. So by using this technical analysis, we are going to identify the trend of the market. So for example, when the market is an uptrend, the probability of the market going up, the price going up, is more than 50-50 because it's in an uptrend. It's not like 100% that is going to go up, but it's more than 50%. So when we trade with the trend, the chances of we being right is more than 50%. That's the edge we're talking about. So the chances could be up to 60 to 70% or even 80. So this gives us an edge over the price direction. So when we trade, we only choose high probability trade, which I'm going to show you how to do, so that our win rate is going to be more than 50%. Next, in trading, just like the coin toss game, we must fix the amount that we are prepared to lose. How do we do that? By setting the certain stop loss. And again, I recommend we risk just 1% of our total capital. You can eventually graduate to 3%, but let's just start with 1%. Again, while setting your stop loss, we should always set a predefined take profit, which is often 1.5% more than the stop loss. And if you do this and stick to it, you will have a positive expectancy. So when you are trading with an edge over the market, when you are trading with a positive expectancy, you already have an edge over the market. So you don't worry about the short-term loss, few times you lose in a day, because you have a bigger picture of what to expect in a long run. And it also helps you not to get greedy or frustrated over a short-term losses or win, because you know that in a short run anything can happen. Nothing happens in a short run is significant to your account, because you know that in a long run you always end up making money. And that's how we do this as professionals. So let me review what I just said in a more clear terms. And we are going to put this in what I call a trading business plan. So if I'm going long on a currency pair, I will enter in a certain price, place my stop loss at a predefined level, and the distance from my entry price to my stop loss is known as the 1R distance. I'll call it the R distance, which is the risk distance. And my profit target should be 1.5R. Again, remember the R means reward. The R in risk means risk. So the 1.5R, the potential return. So I'm risking 1R to make 1.5R. And that is a positive expectancy. So if I apply all the rules and everything goes as planned, will I win all the time? Of course not. I don't have to win all the time. I just have to be right 50 to 60% of the time. And then I'm expecting to get 40 to 50% probability of losing. Just by maintaining this and risking 1 to make 1.5, then it will lead you to a consistent profit in the long run. So to implement this trading plan, we have to make sure that whenever we place a trade, we place what we call a bracket order. And you learn this in the lessons of placing order. I will teach that in a moment. So whenever you enter a trade, you must enter with the 3 order entered at the same time. We talk about the entry point, the exit point. In the exit point, we have the stop loss and the take profit. So the entry price is the price we buy or sell. Now the stop loss price is the price where our trade would have to exit with a loss. And here we have to always prepare for a loss in any given trade. Our take profit price is the price where we exit this trade with a profit. And again, you must always try to exit any given trade, whether profit or loss. So in this case, if I'm going long, say I'm going long on Euro USD at the price of 1.3805. Why? Because I expect the euro to strengthen against the US dollars. So my entry price will be 3805. So before I activate my buy order, I have to place a stop loss, which would be a sell stop order at 3785, for example. And the difference from my entry point to my stop loss is 20 pips. So the way I calculate my profit target in this case is 20 pips times 1.5, which is my profit target. So 1.5 times 20 is 30 pips. So this is how a complete order should look like, having an entry price, stop loss, and take profit. Then the reverse, if I'm going short, if I'm selling Euro USD, I'll add my entry price, my stop loss, and my take profit as well. So let's imagine I'm going short on the Euro USD. And I'm entering at 1.3805 because this time I'm expecting the euro to weaken against the US dollars. So I go short on Euro USD at 1.3805. So my stop loss in a short position is above the entry price. And as always, the stop loss should be 20 pips. And in this case, it's 20 pips above the entry point. So how do I get my profit target? 20 pips, which is the stop loss level, times 1.5. And that gives us the 30 pips, which is our take profit level. So with this, you have to understand that while placing a trade, regardless of the direction you expect the market to go, we always place our entry point, our exit point. And this exit point consists of 2 different types of order. We have the stop loss order and we have the take profit order. So if you do this consistently, let's take a look at a different outcome. So if you do an average of 20 trades per month, and this is pretty minimum considering we have a 24 hours market. So personally, I usually takes about more than 3 trades per day. So if you calculate 3 trades times 20 days, 20 trading days in a month, you get somewhere between 60. But let's say it was a bad month and you took just 20 trades per month. And let's say you have an average win rate of 60%. Again, you don't expect to be right 100% of time, but if you follow the strategy I'm about to teach you, you're gonna be right more than 50% of the times. So let's say each time you place a trade, you are risking 1% and you are getting a potential return of 1.5%. So with a 60% win rate, in a 20 trade, you win 12 times and you lose 8 times. So each time you lose just 1%. And each time you win 1.5% times the 12 times you've won, that is 18%. And with this gain per month, that is 10% return per month. Now this is based on 1% risk per trade. I know a lot of people risk 2%, 3%. Now if you risk up to 3%, you multiply the 10% times 3, that is 30%, and it's quite good. But again, remember, the more you risk on your account, the more volatility that will occur in your account, and the more risk you expose your account to. Because when you get a loss, instead of losing 1%, you lose 3%. And I don't know your risk tolerance, but if this is not safe for you, then there's no need risking up to 3% of your capital. Just go with 1. Because just know this, when you trade, you don't always get a win, a loss, a win, a loss, and lose and win. You don't always get it like that. Sometimes you might have up to 6 losses in a row. And when you're risking 3% of your capital and you have 6 losses in a row, that simply means that you've lost a significant portion of your capital. And if your risk tolerance is not that big, I'll advise that you stick to 1%. So that you will not easily be moved by those tiny losses that do occur in an account. Because when you are entering a trade, you have to expose your mind, you have to get prepared for losses. Because losses is just part of the game. So when you lose 6 trades in a row and you are risking with 3%, that's a huge part of your capital, and that loss might affect a lot of people psychologically. And then you start doubting your strategy, you start thinking about how to take revenge in the market, and that will make you to risk, to expose more of your account to risk, and at the end of the day, you end up blowing your account up. And on the flip side, if they start winning, like for instance, they won 6 trades on a row, 10 trades on a row, because it's possible to win 10 trades on a row. And what that does to your psychology is that it makes you feel like a god in the market. It makes you want to risk more so that you can gain more, because you think the market is now obedient to you. So you should never do that. You have to stick with your trading plan. Come rain, come shine. Whether you are losing or you are winning, you have to stick to your trading plan. So in doing this, you are allowing the statistics and the mathematical edge you have over the market to play out in your favor in the long run. So right here on my screen, it's just the same trade, but this is for people who risk up to 3% of their capital. They end up not having 10% return per month, but up to 30% return per month. So now, what if your win rate is just average of 50%? So there will be times or months when your win rate will drop to 50%. It happens in the market. And there will be also months when your win rate will increase up to 70 to 80%. So 50% win rate means that if you take 20 trades in a month, you are going to come out with 10 wins and 10 losses. And if you are risking 1%, it's going to be 10 times 1.5 equals to 15%. And when you lose, it's going to be 10 times or minus 1%, which is minus 10%. So you see that even in a worst month where your win rate drops to 50%, your net return per month still sticks to 5%, which is a positive return. And again, if you're risking 2%, you get 10%. If you're risking 3%, you get 15% in a worst month. Now again, there could be months, there could be the worst month when your win rate might drop to 40%. I mean, it happens in the market. You can use the best trading strategy out there. You can have the best mentor. We all have our bad days and the good days. There could be months, there could be days when your win rate might drop up to 40%. So now in a 40% win rate, you have 8 wins and 12 losses when you take a total of 20 trades in a month. And that 12 losses times 1% you are risking per trade is minus 12%. That means that you lost 12% of your capital. And even at that, the 8 wins that you have on your account for the month times the 1.5% per month, that is 0 return per month. That is break even. You lost nothing. And this win rate dropping to 40%, it rarely happens. It happens once in a blue moon, but this is something you have to watch out for. This is something you have to expect. This is not something that when you see, you think your trading strategy is no longer working, you need to change, or you get emotional. Always note that there could be a bad month when your winning strategy, that winning strategy that has given you consistent profit in months, there could be months when it has to drop to 40%. It's necessary. But what you have to do in this case, you have to counterbalance it with the time when this winning strategy is giving you up to 70 to 80% in a month. You have to counterbalance this, and you end up having an average of 65 to 70% in a month in general. So let's look at it mathematically. So let's go back to the formula we learned earlier on. This is the percentage win multiplied by the average win minus the percentage loss multiplied by the average loss. And always remember that anytime you use any trading strategy, you have to apply this formula on it. That will help you determine if you have a positive expectancy on this trading strategy. So for example, if your starting capital is 10,000 grand and you decide to risk 1% of the 10,000, which is equals to $100, and your average win is equals to 1.5% times 10,000, which is $150, because 1 R is 1% risk. So 1.5 R is 1.5% gain. So if you put this in a formula, what do you get? So let's assume you get a 55% win rate, which you know is pretty common. So this means that 55% of time that you trade, you are winning $150. So 45% of time, you are losing $100. So if you do the math, you get $37.50 per trade. So is this a positive strategy? Is it a positive trade? Yes, it's a positive trade. So as long as you come out with a positive number, it shows that your trading strategy is a positive strategy. So all the trading strategies I'm going to be teaching you on this channel, they all have a very high positive expectancy. So what this means is that if you do an average of 20 trades per month, statistically you should get $750 per month. So $750 per month is about a 7.5% return per month on your $10 worth of capital. Again, this is on a 1% risk per trade. If you risk 2% or 3%, your profit will be double, times 2 and times 3. Now next, what makes a successful trader? So to become a successful trader, there are 3 major components that you need to have. And the first and the 10% of what makes you a successful trader is that you need to have a trading system. And not just a trading system, you need to have a trading system that has an edge over the market. And this is something that this course is going to be giving you. A trading system, a functional trading system. Now at the same time, you can have the best trading system and you can still end up blowing your account. So this is because even the best trading system out there, there are months, there are days that it doesn't always work out. So there are some months when it has a series of losing streaks and a series of the strategy not working out. So in those times when you have those losing streaks, what happens if you are risking, say, 20 to 30% of your capital? You end up losing the whole capital because despite having the best trading strategy, you lack risk management, and that is one of another component of a good trader. So the second part of what makes a successful trader, which comprises of the 30% of what makes a successful trader, is the position sizing. Knowing how to calculate the number of lots to trade in such a way that you keep the risk per trade consistently and small. So I'm going to teach you that on the lessons on position sizing. So the 60% of what makes a successful trader comes from their mindset, their psychology, their ability to manage their emotions. So the only way to manage your emotions to overcome the usual fear, greed, and hope, and be able to trade logically, consistently, and constantly, so you must have the motivation to actually place the trade, and the discipline to follow the rules, and the focus to stick to the rules, and the determination to know that when things doesn't go your way, that's fine. Don't give up, keep taking trades, trusting on your strategy, because you know that according to your strategy, you always make money at the end of the day. So the next is the 4 keys to successful trading. Now number 1 is your entry setup, and the number 2 is your exit strategy, and 3, risk control, 4, trading psychology. So number 1, knowing when to enter your trade. Number 2, knowing the strategy to exit. So these first 2 makes up your trading method and strategies. So the third one is the risk control, which is risking a very small amount of your capital, minimizing your risk exposure, and having the right trading psychology to always and consistently follow your rules, no matter what the emotional conditions are, without fear, greed, hesitation, or resistance. And this brings us to the end of today's lesson. And if you have any question at all, kindly drop it down at the comment section and I will be glad to assist on your questions. Thank you and bye for now.